In this lecture, we will study scenario planning, uncertainty, and strategic financial projections. Now, let's start with a simple but powerful idea. Financial planning is about the future, but the future does not arrive as one clean number. Sales may be stronger or weaker than expected. Costs may rise. Customers may pay more slowly. Capital projects may become more expensive. Financing may become easier or harder to obtain. So, a good financial plan should not be treated as a perfect prediction. It should be treated as a conditional model. In other words, the plan asks, what happens if our assumptions are correct? And also, what happens if our assumptions are wrong? This is the heart of planning under uncertainty. We are not trying to eliminate uncertainty. That is impossible. We are trying to become prepared. A useful plan helps managers identify the assumptions that matter, the points where the firm becomes financially vulnerable, and the actions management can take before problems become urgent. By the end of this lecture, you should understand how scenario planning turns financial projections from static forecasts into practical decision tools. Let's begin with forecasts. A forecast often looks precise. It may show expected sales, expected margins, expected cash flows, and expected financing needs. But we must be careful. A forecast is not a fact. A forecast is a collection of assumptions. Some assumptions are about the market. Will customers buy the product? Will demand grow? Will pricing remain stable? Will competitors respond aggressively? Some assumptions are about operations. Can the company produce efficiently? Can labor costs be controlled? Can inventory be managed well? Will capital spending stay on plan? Other assumptions are about financing. Will lenders continue to provide credit? Will interest costs remain manageable? Will the firm issue debt, issue equity, pay dividends, or repurchase shares? There are also external assumptions. Inflation, exchange rates, regulation, macroeconomic conditions, and investor confidence may all affect the forecast. This distinction matters because spreadsheet accuracy is not the same as forecast quality. A model can calculate everything correctly and still mislead us if the assumptions are unrealistic. That is why disciplined financial planning separates assumptions from calculations. When assumptions are visible, managers can challenge them, revise them, and understand what really drives the projected outcome. A strong forecast is not just a set of numbers. It is a clear explanation of how the business is expected to perform. Now let's talk about scenarios. A scenario is an internally consistent set of assumptions about how the future may unfold. That phrase is important. Internally consistent. A good scenario is not just a higher or lower forecast. It tells a coherent financial story. In a favorable environment, stronger demand may improve operating leverage, support pricing, and increase the need for capacity and working capital. In an unfavorable environment, weaker demand may pressure margins, slow receivable collection, create excess inventory, and reduce borrowing capacity. Notice how several assumptions move together. That is what makes scenario planning valuable. It forces us to think about business conditions, not just isolated line items. Many planning models use a base case, an optimistic case, and a pessimistic case. The base case is the central planning case based on current information. It helps establish the main operating plan and financing plan. The optimistic case is favorable but still plausible. It tests whether the firm can scale without bottlenecks. The pessimistic case is unfavorable but still plausible. It tests liquidity, borrowing capacity, covenant risk, and contingency plans. In many cases, the pessimistic case is the most valuable. It helps management ask, what breaks first? Is it cash, credit capacity, supplier confidence, investor support, strategic flexibility? The main question is not which scenario will happen. The better question is which decisions are robust and which decisions become dangerous if conditions deteriorate. Scenario analysis and sensitivity analysis are related, but they are not the same. Scenario analysis changes linked assumptions together. It asks, what happens to the firm under a plausible business environment? For example, a weak business environment may include lower demand, margin pressure, slower collections, and tighter financing at the same time. Sensitivity analysis isolates a single key assumption while holding the rest of the model constant. It asks which driver has the greatest effect on the result. This difference is very important. Scenario analysis helps managers understand environments. It shows how the firm performs when several business forces interact. Sensitivity analysis helps managers understand drivers. It shows which assumptions deserve the most attention because small changes in those assumptions can create large changes in results. Strong financial planning usually uses both. Scenarios show the story. Sensitivities show the pressure points. Managers may also use probability-weighted scenario analysis. This means assigning probabilities to different scenarios and summarizing the expected result. That can be useful, but it should never replace the detailed scenario view. Why? Because an average can hide danger. A probability-weighted result may look acceptable, while a severe downside scenario still creates a serious financing problem. So, use probabilities carefully. They can summarize uncertainty, but they should not erase it. Good planning keeps both the expected outcome and the downside exposure visible. Financial projections are not just accounting exercises. They are quantitative expressions of strategy. A revenue forecast may assume that customers will adopt a new product, that the firm can defend market share, that pricing power will remain strong, or that distribution capacity will be available. A margin forecast may assume that fixed costs can be spread across a larger sales base, that input costs will remain manageable, or that productivity improvements will occur. A capital expenditure forecast may assume that the firm can expand capacity on time and at a reasonable cost. A working capital forecast may assume that customers pay on time, inventory turns efficiently, and suppliers provide favorable terms. These are strategic assumptions, not just spreadsheet entries. Most strategic financial projections focus on a limited set of core drivers. Sales growth affects revenue, scale, working capital, and capacity needs. Operating margin affects operating profit, taxes, and operating cash flow. Working capital intensity affects how much cash becomes tied up in receivables, inventory, and payables. Capital expenditures affect capacity, assets, depreciation, and cash requirements. Financing policy affects liquidity, leverage, payout capacity, and financial flexibility. The model may contain many rows, but managerial attention should stay focused on the drivers that explain most of the change in cash flow, financing need, and risk. A projection becomes much more useful when every major line item is connected to a real business reason. Now, let's connect projected income to projected cash flow. A company can report accounting profit and still need financing. This is one of the most important lessons in financial planning. Why can that happen? Because growth consumes cash. The firm may need to invest in inventory before products are sold. It may extend credit to customers before cash is collected. It may spend on equipment, technology, or facilities before the expected revenue arrives. That is why free cash flow is so important. Free cash flow asks whether the business generates cash after supporting operations and required investments. If free cash flow is negative, the firm must find a way to finance the difference. It may use cash reserves, reduce distributions, borrow money, issue equity, sell assets, or change the operating plan. Managers also look at the financing gap. The financing gap measures whether planned uses of cash exceed internal operating cash flow. A positive financing gap means the plan requires outside support or internal cash reserves. A negative financing gap means the plan generates cash after funding the listed needs. This is where the balance sheet becomes essential. Sales growth may look attractive on the income statement, but receivables, inventory, and capital expenditures may absorb cash. So never evaluate a growth plan only by projected profit. Always ask, when does cash come in, when does cash go out, and what financing is needed in between. A useful planning model does not need to be unnecessarily complicated. The model should be detailed enough to capture the economics of the business, but simple enough for managers to understand, challenge, and update. A practical model usually separates inputs, calculations, and outputs. Inputs are the assumptions. These include sales growth, margins, tax rates, capital spending, working capital ratios, interest costs, payout policy, and financing choices. Inputs should be easy to find and easy to change. Calculations translate those assumptions into financial consequences. This is where the model connects the income statement, balance sheet, cash flow, debt balances, interest expense, and financial ratios. Outputs are the decision signals. These may include cash balances, financing gaps, debt capacity, covenant measures, return measures, and funding needs. The best models make assumptions visible and decisions clear. Good model design also avoids circular confusion. For example, interest expense may depend on the amount of debt required, while the amount of debt required may depend on the cash shortfall after interest. Managers need to understand how the model handles these links instead of accepting the spreadsheet output mechanically. Transparency is the goal. Assumptions should be easy to inspect. Calculations should follow business logic. Outputs should highlight decisions rather than burying them in unnecessary detail. A planning model is not valuable because it looks complex. It is valuable because it helps managers think clearly. Now, let's discuss stress testing. A stress test evaluates how a plan performs under adverse but plausible conditions. It is different from a normal downside case. A downside case may represent a weaker than expected result. A stress test asks what happens when several pressures arrive together. This is especially important for growth plans. Growth can increase risk before it increases cash flow. The firm may need to hire employees, build inventory, extend customer credit, sign contracts, or commit to capital expenditures before the expected revenue is collected. Stress testing helps managers identify breakpoints. A breakpoint is the level of performance or financing capacity where the firm must change course. Managers should watch early warning indicators. Are projected cash balances declining? Are working capital needs rising faster than sales? Is the company using short-term borrowing to fund long-term assets? Are major capital expenditures happening before operating cash flow improves? Are debt maturities arriving during weak cash flow periods? Are covenant measures approaching contractual limits? Is the financing plan relying too heavily on optimistic valuations or favorable capital markets? Financial managers often monitor liquidity, leverage, and credit metrics to see whether risk is building. The purpose is not to create fear. The purpose is to create preparation. A good stress test gives management time to act before a financing problem becomes a strategic constraint. Financial flexibility is the ability to fund valuable opportunities and withstand adverse conditions without being forced into costly actions. A flexible firm can delay investment, accelerate investment, refinance debt, draw on committed credit, reduce payout, sell non-core assets, or raise capital on reasonable terms. This flexibility has real value because uncertainty has real consequences. A growth plan should therefore be evaluated not only by expected return, but also by its effect on flexibility. A plan may look attractive in the base case, but still be risky if it uses all borrowing capacity, leaves no room for cost overruns, or depends on raising capital exactly when markets may be weak. Managers can preserve flexibility by staging investment rather than committing all capital immediately. They can maintain sufficient cash and unused credit capacity. They can match financing maturity to the life of the assets being financed. They can build contingency plans for working capital needs. They can avoid payout commitments that conflict with investment needs. And they can negotiate financing before the firm urgently needs it. This is where financial planning becomes a decision tool. The plan should help managers compare strategies, set priorities, and define decision rules. The best strategy is not always the one with the highest projected revenue. Managers must also consider risk, cash flow timing, financing requirements, reversibility, and strategic fit. A strong plan does not simply describe what managers hope will happen. It defines what managers will do when conditions change. Finally, let's discuss communication and common pitfalls. Financial projections are often shared with executives, board members, lenders, investors, and operating managers. Clear communication matters because stakeholders may focus on headline results and overlook the assumptions behind them. A credible financial plan should communicate the assumptions that matter most, the difference between controllable and external assumptions, the range of plausible outcomes, the financing need under each scenario, the actions available in downside conditions, and the triggers that would cause management to update the plan. A polished forecast is not necessarily a credible forecast. Credibility comes from transparent assumptions, clear logic, disciplined analysis, and a willingness to discuss uncertainty directly. Now let's remember the common mistakes. Do not treat the base case as certainty. Do not create mechanical scenarios that simply move sales up or down without a business story. Do not ignore the balance sheet. Do not underestimate working capital. Do not bury assumptions. Do not overbuild the model. And do not forget to update the plan when conditions change. The most useful plans are disciplined but adaptable. They combine financial rigor with managerial judgment. That is the essence of scenario planning, uncertainty, and strategic financial projections. Thank you for watching. I look forward to seeing you in the next video.